Well,
gold?
so for one, I don't do price targets because that relies on guessing what other people are going to like determine something is worth within like a 12-month period, right? So that's more
Hmm.
like technical analysis, kind of like if or trading sort of things. I focus on long-term fundamentals. So my approach instead is about determining what something is worth relative to other assets. And so currently I do view gold as probably like undervalued compared to a number of other things you can buy, especially on a risk-adjusted basis.
Hmm.
And so I'm bullish on, I think it's constructive to own physical gold, in your possession to, like at least to a small degree. I think it's a useful hedge to have. Um, and if you look back in history, so for example, gold generally does poorly like during liquidity crunches, right? So if liquidity is coming out of the system, if the dollar is going up very like significantly, then gold priced in dollars is unlikely to do pretty well. And that's kind of what we saw throughout 2022.
Hmm.
It held up better than equities, it held up better than bonds, but it didn't do very well. In 2023, if we have an earnings recession, so corporate earnings are doing very poorly, and maybe liquidity is flat, right? It's not great. It's not the driving factor anymore. That's where I think could see gold start to outperform. So gold generally does poorly if there's a liquidity crisis. So for example, March 2020, or the opening salvo of the 2008 recession, right? So gold takes a hit along with everything else like in the initial phase, but as the thing grinds on, that's when gold can start to rebound where equities still have lower to go. So I'm it's everything's probability based, but I'm more bullish on gold than equities, or at least broad equities, in 2023, especially on a risk adjusted basis.
Can you briefly explain why gold takes such a hit during a liquidity crisis? I think a lot of folks kind of get that backwards when they
Yeah.
expect it to all shoot up, then all of a sudden it takes a big dive and they're like, this don't make any sense.
Yeah, so if you look at 2001, 2008, 2020, right? These big
Yeah.
sharp sell-offs, where everything the problem is, a lot of people that own equities also own gold, and so they're getting margin called. And it's the classic phrase like you got to sell what you have or what you can, not what you want to.
Exactly.
And so
Yeah.
we sell kind of like what is still liquid, what is holding up well. In addition, basically things are priced in dollars, and if the dollar is ripping higher, basically the dollar is hardening because of a liquidity crisis. Everything's priced in dollars, and dollars are like briefly in short supply, and so everything's like okay, sell everything else to get dollars. And so for example, in March 2020, should gold logically have gone down now that there's like a global pandemic and lockdowns? Probably
Right.
not,
Yeah.
right? Should Bitcoin have gone down? Probably not, but it got like cut in half temporarily, right? And these things happen not because their earnings are going down, because gold and Bitcoin don't have earnings, but it's because you're like, okay, sell like I'm already hit, I'm levered long, I'm wrecked now, I gotta sell my gold, I gotta sell my whatever. And so when those things happen, there's often like this like period where you can buy things that shouldn't have been sold, but that were. And there are other things that's going to take longer to recover, right? So for example, cruise ships did not like recover after, like after
Yeah.
the pandemic hit, whereas like once the liquidity set in, gold and silver shot back up and Bitcoin, right? So there are things like that where everything goes down together, but then you can separate, okay, what is actually fundamentally hurt versus what was just sold because it was in someone's portfolio and they had to sell.
Yeah, exactly. Great, great explanation there.